Good evening, and welcome to the April Investor Update, where we're going to spend some time talking about creating, growing, protecting, and preserving family wealth in today's economy. As always, during these workshops, each update, we look at different ways to help maximize that. I've had a lot of opportunities since the last webinar to visit with some of you, plus to do some additional research on what we're doing here. I'm sorry, we got a signal and a signal problem. I'm just trying to fix that for us. Okay. So we'll be talking about some of the information I've gathered since our last webinar to discuss opportunities for how to handle the market in today's environment. I feel kind of like I've got some good news to share with you. It's not great news or perfect news, but it is an improvement over what we talked about in our last discussion. So let me go ahead and share, and then we can always, the disclosures are critical to everything we talk about, are still essential for you. Whatever we talk about, whether it comes to making changes to your investment or adjusting an account because of market issues or tax issues, flexibility, etc. All of these represent opportunities for you to consider the tax impacts. If it has to do anything with estate design, beneficiary changes, make sure that you've thought that through. And again, if you have any questions, you can certainly check with me or our staff here, and we'll be happy to answer them. But if we're outside of our depth, we'll certainly refer you back to your accountant or your attorney, et cetera, to help make good decisions when it comes to managing your wealth wisely. We'll always, as always, we'll take a time for questions here towards the end. You can certainly either raise your hand and I'll be able to see that, or you can type your question in the chat box, and I'll be looking for that as well, so we can make those adjustments also. So without further ado, let me tell you that we're going to cover fundamental and technical analysis review. Very quick review. I know I've talked about it in the last two updates. I feel like by now you're all experts at it, but I'll just quickly hit a few points on it. Remind you of the four primary engines of economic growth and how that's impacting us right now. Recession potentiality. Do we have, how strong is that recession potential? Potential entry and exit strategies, how we might want to approach those and what we're looking at from the technical analytics. Market reviews, as far as portfolio management options, we'll take a look at some of those items as well. Diversification for your portfolio management, reminder of the wealth management apps we provide you, your questions, and then the next investor update. So as just a quick review, like I said, we've covered this before, so you're probably pretty much on target with it. But just, again, we talked about in previous webinars, what is fundamental analysis? That is taking a look at the economy and the markets and determining, should we be invested in them? Is with the individual security, should we consider that company as a strong or economically viable organization to invest in? Technical analysis says, even if it's a strong company, would we invest today? What is a correction? A correction is a 10% pullback in the market. What is a bear market? That's a 20% or more pullback in the market. What's volatility? Volatility is that measurement that's identifying how aggressively and how fast the market's going up and down. Going through a volatile time frame can be terrifying, but it's certainly just usually a temporary experience. What is recession? Recession is measured as either 2 quarters of economic decline in the GDP, although there have been organizations now that are calling that a little longer than 2 quarters, or looking at months in some cases, but it's still that economic decline in GDP growth, and looking at that issue as to how it's going to impact the economy and the markets. These pieces, as we talked about during the pandemic, and quite honestly, as we've talked about here most recently, these are things that I'm watching, as I think you are, to try to make determinations on, do we pull back? Do we stay where we are? Do we look for opportunities? Do we make adjustments, etc., to try to figure out the best modeling for your portfolio and for what our job is to manage wealth wisely for you? Back to creating, growing, protecting, and preserving wealth. That's part of how we use these resources to answer those questions. So when I talked last time to you, I talked about how I was concerned about recession And I'm not done being concerned about it, but we certainly have seen a lot of information that's sort of changed that thinking a bit. Not that it's not going to happen, but maybe how or when it's going to happen. So as a reminder from our last time, I showed you the comparisons of the Dow as compared to the gray bars there representing recession. And you'll note that in sort of the obvious ones, the Great Depression, you'll note in the period of time for the Y2K and 9/11 experience, you see a recession there. The Great Recession, 2008 through 2009-10, somewhere in that ballpark. And then the pandemic, you'll see a very tiny little gray line there because that was basically 1.5 quarters where we saw that as a recession. You'll note that on those recessions, every one of them, the ones I mentioned, plus the many on here I didn't mention, those represent times when the market definitely goes down. And our goal is to minimize our loss during those times, because if we can minimize loss in those times, it gives us opportunity to move back into the market with more money rather than try to follow it all the way down and then ride it all the way back up again. That strategy is fine. A buy and hold strategy works well. I'm not opposed to it, but we try to operate for you with a grow and protect strategy. And we can't get it every time because we're not day traders. But when we look at the trends and we do trend management, this is part of what we look for. And these recessions are part of how we think about this. So pulled this off of, actually pulled up a number of articles I thought might be helpful for you to think about. The stock market has predicted 9 of the past 5 recessions. Yes, think about that for a second. The stock market has predicted 9 of the past 5 recessions. That actually comes from a joke from Master Keynesian of decades ago, Paul Samuelson. Samuelson's great rival on the supply side of economics at the Wall Street Journal. He wrote or completed that sort of joke when he quipped that in the other 4 recessions that didn't happen, Washington got the message and mended its ways in time. The question I think for all of us right now is the recession that we're facing, is it one of the 5 or is it one of the 4 where the market, where the Washington elite have figured out how to make the right decisions? The stock market is wobbling, and that comes from a Forbes article online, actually back in 2018. It's not a current article, but I thought it was a great quote that I wanted to use again. So the question from my viewpoint is recession in 22, recession in 23, recession in 24. Pre-Russia and Ukraine, it was a discussions of 23, probably 24, but with what's happening with Russia and Ukraine, as well as many other factors right now, it's looking like it could happen sooner rather than later. Having said that, though, when we look at the data, it might not be quite as bad as we think. If you're sitting there thinking to yourself, but wait a second, Frank, everywhere I turn, I find information about recession. April 12th of this year, CNN Business, where a recession shock is coming, Bank of America warns. Bloomberg, the Fed has made a US recession inevitable. Jerome Powell is far too optimistic about the chances of a soft landing. CNBC wrote that the bond market is flashing a warning sign of recession, that it may be coming, and here's why. And then the Epic Times of London wrote, is a recession coming in 22 or 23? That was April 5th, they wrote that. So the question we have to figure out is, what are we looking at here as far as the market and the economy and its impact upon what I do for you and your family's wealth management? Let me remind you of the 4 primary engines of economic growth. And when I say these 4 primary, these are leading indicators. These are not lagging indicators. They are things that we can watch as we look at how the economy is being impacted and then make determinations on where we think things are headed. So those 4 engines are GDP growth, or gross domestic product growth of the US, business profitability of, say, the S&P 500, for instance, unemployment rates and where employment numbers are in today's environment, and then interest rates and where they are. Now, you might be surprised to see that inflation is not one of those. Inflation typically tends to be a lagging indicator, and it can certainly impact some of these engines. Maybe, for instance, that inflation could be a flock of birds that hits one of the engines and takes the interest rate engine out. That's certainly a possibility, but it is not a leading indicator. It is just a process that we use to determine the overall economic comfort or strength that we have in the markets and the economy at this point. And we look at these primary 4 to get a feeling for where we think things are as it relates, maybe say, to a recession that's coming in the future, near term or long term. So let's start with looking at GDP growth. And what you're looking at here is GDP growth based upon looking back at July of 2019 clear to the fourth quarter of 2021. Now you'll note that this right here, the negative 5.1 and the negative 31.2, for any of you who attended the pandemic investor updates I did back in 2020, you'll notice that we talked at length about these as they were happening and then talked about expectations of the upside. And here's what we saw on the upside in that third quarter of 2020, we saw a 33.8% uptick on growth in the gross domestic product, which was exactly what we had anticipated, or very, very close to what we had anticipated. That was fantastic. Then we saw a 4.5 growth, a 6.3 growth, and a 6.7 growth. In the last quarter, the Q3 quarter, we saw 2.3 growth, was a little bit on the low side, but still above 2, which was acceptable. We like 3 is a better number. And then last quarter was 6.9. As we look at what we're going into this coming year now, the numbers are being restated, and so what these are estimates. So what we're looking at in February of 22, a 7% consensus. March of 22, a 7.1% consensus, and then a consensus in April of 1%, which is kind of low, but then you average these out and you end up with a number there. So if we're looking at GDP growth as a measurement of potential recession, we don't see it here yet. Now, granted, when we had the pandemic, that was a rapid decline in GDP growth, or in this case, GDP loss. What we'd look for is something that is a more trailing viewpoint, which, as a matter of fact, if you look at the previous 3 quarters before the pandemic, it was going down 3.2, 2.8, 1.9. And it was a sort of expectation that we were moving towards a recession. We just didn't know when or where, and the pandemic changed everything. And then we came out of the pandemic, primarily because of the number of factors. We saw a great amount of growth, even though there was a lot of weirdness in the country. It still looked pretty strong, and it still continues at this point to look pretty strong on gross domestic product growth here in the US. So what about if we look at earnings per share? Now, just to make sure that we're all on the same page, this is earnings per share of the S&P 500 companies, all of them, and looking at an average among them. And earnings per share, or EPS, is calculated as a company's profit divided by the outstanding shares of its common stock. The resulting number serves as an indicator of a company's profitability. The higher a company's EPS is, the more profitable it's considered to be. And when we look at some of the previous numbers here over the last few years, here's 2020, now we're moving into 21, here's 22, and then this is an estimate for 23. But even now, just looking at 22, we can see that it has been moving up. And the estimates, and this was actually just a week or two ago, this number came out, it's an estimate still going up. So again, we can sit and talk at length about why our corporation's being profitable. Maybe some of those things we wouldn't like, maybe some of them we would like. But the bottom line is, when you're looking at corporate profitability among the top 500 companies in America divided up by various industries, it becomes difficult to say, well, this is a weak number to work off of. Certainly this back in the pre-pandemic and then during the pandemic, that was difficult, but we're not seeing any of that right now. And so consequently, this number still looks pretty good even as we estimate out into the future. Is this guaranteed? By no means. But current numbers, it does not look too bad. So what about if we look at unemployment rates? So we go back to 2002 and we can see unemployment rates at a roughly 6%. In 2004, they're 6 to 5%. They come down in 06, 08, they come back in. They move up. During the recession, unemployment rates were at up roughly 10%. Then they continue to work their way down until we hit the pandemic. At that point, they were about 3%. Pandemic threw unemployment up above 14, almost 15%, which you may remember that information and how the media was yelling about that. And then finally, we see it's come back down, and it's now down around 3.8, 3.9 again in today's environment. Again, that's a decent number. Whatever the issues are, and we could take a look at, for instance, underemployment. That'd certainly be a fair conversation. But if we're looking at unemployment at this point in time, we find that that's a decent number as well. So we're looking at GDP growth as one of the engines. We're looking at corporate profitability for the S&P 500, for instance, overall as one of those factors on that engine, and we're looking at unemployment. These numbers still look reasonable. They still look strong. And so consequently, it leads us now to go to the last one, which is interest rates. And the higher the interest rates are, the more difficult it is for a corporation to be profitable. So we go all the way back here to the 1950s. I think this is 1954, and we can see interest rates approaching 4%. Then in the 60s, they dropped way down. Then they came back up. And by the 70s, we were looking at 11% almost. Then they dropped down in the 70s. Then they went up almost to 14% during that recession. We see it drop back down again. Just like in the previous charts, these gray bars represent recession. We can see in the recession there, late 70s, in the early 80s, we had interest rates up over 20% at some point. And then they have consistently worked themselves down so that by 2009, we were looking at almost zero interest rates. We were starting to tick back up again here in the late 2000, like 17, 18, and so on, started to tick back up. And then they have dropped back down again as a result of the pandemic and that recession. And then we now see they're starting to tick back up again. Current Fed rate, which is the rates used for banks to borrow from each other, which then begins this domino effect where banks charge more money to loan to us, and then credit card companies charge more money, and car loans cost more, and so on. It's currently up to about 0.33, and certainly that is the start of a piece of concern. And we're going to talk about that in a second as well, because if the Fed and if Jerome Powell does what he said he's going to do, which is raise rates as much as 5 times, maybe even 6, the first one happened here back in the March meeting, that could certainly cause us some challenges to the economy. But at this point in time, this interest rate is still a decent rate and still does not trigger or give a real serious viewpoint to inflation, or to, rising interest rates, which would slow down the economy. So if I were to score these engines, I'd give GDP growth a plus, I'd give business profitability a plus, I'd give unemployment rates a plus, I'd give interest rates a plus, but because I'm aware that the Fed has talked about raising interest rates, I'd give it a plus minus. That means that I'm concerned about it, and I'm concerned what it could mean for the future, but at this point in time, I'd still just give it a plus minus. I would not give it a minus yet. And you may remember back in the late 2008, 2007, those times when we were going through that pandemic, those were all negatives. When I've shown this chart in the past, GDP growth was a minus, business profitability was a minus, unemployment rates were a minus, and interest rates were about the only positive on the planes. We had one engine holding the plane up. During the pandemic, they still held, and that wasn't a problem. Currently, this is where we are now, at least in my opinion. And so as I look at this, it makes me think, well, we're further away from a recession than I was thinking in the conversation we had last month. Can things change? Absolutely, they can change. And if they do change, we will be talking about that. But for now, I'd say, maybe it's not so bad at this point in time. Back to that question, are we looking at recession in 22 or 23, 24? Maybe, I don't know. I think there's many factors that we have to consider. Now, with that rising interest rate question, let's talk about what that means, because you might be saying to yourself, why do rising interest rates have any impact on lowering inflation? Because that really is one of the questions. That's why the Fed is talking about raising interest rates. And so here's the answer, just so we're on the same page. Rising interest rates equals decreasing inflation rates, because higher interest rates reduce demand on products. And that reduced demand then lowers inflation. It slows down the economy. Now, here's why. Let's say you want to buy a car and interest rates are twice what they are right now. Many people would say, well, I'm not going to buy a car right now. Or let's say you want to take a trip and you don't have a lot of cash, or you don't want to use your cash, and so you're going to put it on credit. Many people would say, well, I'm not going to take a trip right now. And there's a number of things that rising interest rates will slow down the supply and make the demand catch up to the supply. That's what the Fed thinks, and it's not a wrong-headed idea. It's what the Fed thinks about how they're going to control inflation, is that if you slow down demand, you get a chance for supply to catch up to it. So here's the concern. The risk of rising interest rates too quickly could be problematic. The global economy has been dealing with massive supply chain disruptions and shortages, and these problems have driven up the production costs. Let me stop there for a second. If it was just a regular environment, supply and demand was functioning somewhat like normal, we probably wouldn't be seeing the same inflation that we're seeing now. But there's no doubt that how much of this inflation, whether it's permanent or transitory, is being impacted by the supply chain issues, which makes it more transitory unless we can figure out how to fix those supply chain issues. Having said that, the Fed has no capacity to fix supply chain issues. That's supposed to be other processes in place, and the government seems to not be doing a good job with that. That's my opinion, but I do see private entrepreneurs starting to fix some of those lines, and I think that's helping. But having said that, the Fed doesn't have the ability to fix supply chain, but it can adjust supply and demand by raising interest rates. So if high US inflation stems mainly from higher production costs and lower inventories, then the Fed might have to raise interest rates a lot to contain inflation. And the higher and the faster the Fed raises rates, the more harmful it'll be to our economy. The reality is that there have been very few times that the Fed has created a soft landing. And this is one of those times where they're working to create that soft landing for the markets, for the economy, for the economy not to crash, but rather just slow down a bit. Back to that comment a moment ago, that the stock market has predicted 9 of the last 5 in recessions. Sorry, had a moment there. The stock market predicted 9 of the last 5 recessions, and then his counterpart said, well, yes, because the government fixed 4 of them. And that was mean they created a soft landing. There have been several times where the government has created a soft landing. They've certainly created hard landings because the Fed tends to be slow to the process of raising or lowering interest rates. And so the big concern right now is, are they going to be fast or slow in the process? Are they going to be hard and make it so that those rates cause the market, the economy to slow to a halt rapidly? Or will it be a soft landing, making it much easier so that plane that you just saw a moment ago can land comfortably, meaning that it has to come down. There's got to be a pullback. It always is natural. But if it's not hard, then we can avoid recession, and we'll just have correction, not bear market, etc. Or even if we have bear market, it'd be very short-lived. If we do have recession, we could be looking at 18 to 36 months of economic problems. And so we want to try to plan ahead for that. Again, as an advisor, we're trying to look at how we would handle that to take advantage of opportunities, be proactive wherever possible, and reactive whenever necessary. So this is part of how we're reviewing that information as well. When we look at the additional analytics that we have to be aware of, the Russia-Ukraine war, which I mentioned before, certainly been a domino that we did not expect in this process. I mean, you go back to January, I knew that Russia was doing some saber rattling. I think most of us did, but I wasn't sure they were going to jump in and do what they've done. So I couldn't account for that, as there'll be many things in the future I can't account for. But I'd also say I couldn't have accounted for the fact that Russia can't seem to even be able to defeat Ukraine, that Ukraine is knocking their planes out of the sky. Ukraine is destroying some of their tank columns. Ukraine is actually taking down some of their heavy warships. So I wouldn't have thought that was going to be an issue either, but it seems that Ukraine has done some amazing work in this process. Number 2, expanded geopolitical concerns, which would have to do with potential international conflicts. I just saw an article the other day. Is this ramped up work with NATO and Ukraine going to start something bigger? Russia's already saying that it kind of has, but I'm not quite sure that makes a lot of sense because they can't even handle Ukraine. What would they do with NATO? But it certainly is a possibility. It doesn't mean that somebody wouldn't be dumb and do something ignorant in the process. Number 3, unresolved supply chain issues. It's hard to say how fast those issues are being resolved. Some things are happening faster, other things are happening slower. I was just talking with a person today buying some things, and they were saying that some stuff now they couldn't get before, but now they can, and other stuff that they used to be able to get, now they can't. And it's kind of weird how it kind of changed on it. So unresolved supply chain issues could make this worse, could make this better, just depends. The Federal Reserve Board meetings coming up May 3rd and 4th and June 14th and 15th. Expectation is they're going to raise rates in both those meetings. Hopefully it'll be no more than 25 basis points. Don't know though. Depends on how the economy is doing. If the economy is still doing pretty good, they would likely raise rates to try to reload the gun, if you will, the market, the economy, so they'd have some room to adjust if we really did go into a recession. Lowering interest rates, that's kind of what they're trying to do, get the interest rates up a bit so that if a recession really happens, they can lower them again to kind of adjust the flow and velocity and volume of money and currency. Number 5, expanded geopolitical concerns, potential international economic weakness and recession. It's not just the US that's facing recession, it's other countries around the world, some much greater than ours. We've seen emerging markets stumble and struggle to make money and to see those markets do well. That certainly adds weight to the rest of the world. And so that could be something that there could be more issue with. Again, we don't know. It's a question of all the things that we're unaware of that we have to be looking for continuously. Number 6, the current Biden administration's energy policy. It has hurt things. I'm sure that if you're a Democrat listening right now, you're like, well, I don't think it has hurt anything. It's probably the oil companies and so on. You know, it could well be that. But if you look at the amount of profit an oil company makes and you look at the amount of tax that state and federal and local governments take on the gallon of gas you buy, you realize that their policies with taxation are as, if not more, detrimental to the gallon of gas that you and I are paying for than the profits off of an oil company. I would also say that more supply offsets demand issues. Of course, a slowing economy changes demand issues, so it's not such a problem. So we'll have to wait and see how this works. Could it work out easily? Could. Could it be problematic? It could. We'll just have to watch it step by step. On a side note, for many of you, you realize that when the pandemic hit and a few months later we decided to purchase energy securities with USO, which is oil supply, and XLE, which is energy distribution, we just recently got out of that to the tune of having 100% return for some of you in a few of those accounts and almost 90% in another one of the accounts. So the fact is there are opportunities to take advantage of even in something like energy and how that works. Again, there's no promise that anything can work out. It's just a process trying to make the best decisions we can with all of the data we have, because there's always something that's not working well, and at the same time there's always something that is working well, and the ability to be flexible, to make adjustments, to change accordingly is essential to creating, growing, protecting, and preserving wealth for your family and your financial future. And then finally, additional domestic economic weaknesses and/or recession. Again, they all kind of fit back into some of these pieces here, but there could be a dozen other pieces that we're not aware of yet that could be out there. And so staying on top of this, watching it, trying to make wise decisions in the process, that's my job, but it's also your job. Some of you come to me and you'll say, hey, I saw this, have you seen this article? And I look at it and I think, okay, that's important. And sometimes I look at it and go, I don't think that's as big an issue, but I always appreciate you sharing information with me that you're seeing, because it helps me to, 1, understand what you're looking at, and 2, how that might impact your portfolio, and 3, maybe sometimes actually take that information and use it to help you and the rest of our clients create, grow, protect, and preserve wealth. So with that in mind, let's take a look at the equities markets today, just to kind of update. You may remember this is what the chart looked like when we were last in here in the markets. We see we were well below the 200-day moving average. We see that and this is for the S&P 500, we can see that the 50-day moving average had run into the 200-day moving average. And so those were pieces that were a little uncomfortable. But now let's go ahead and take a look at where we are today with the economy, the markets. So here we are. This is, actually I'll go ahead and start with the one we just looked at, so that way it's similar for you. go. One second. There we go. Okay, so here's the S&P 500 again. This is obviously back at the pandemic, and you can see that it took until about October for us to break above the previous high we'd had before, and then it took off in November, and from that point forward it's gone up, and then it's only been here recently in January where it kind of hit a peak and then it's gone down. If I break this out and try to look at it now, instead of 2 years and 6 months, let's just look at it for 6 months. What you'll see more specifically now is that the 50-day moving average did finally or ultimately break below the 200-day moving average. You'll see the daily activity broke above, and you'll note that there was some pretty good volume here a couple of days as it went up. It broke above the 200-day moving average. It came back down. It didn't hold it. It broke down through the 200-day moving average, and then notice this here, it hit the 50-day moving average, and it's kind of held. And I mentioned to you before, that's one of the indicators we're looking for. Will it hold? You may note that the blue line, the 50-day moving average, is going a little bit negative right now, but it's not terrible. And you'll note that with the particular performance we're seeing right now, it is trying to find its floor of support and its ceiling of resistance. The 200-day moving average is, however, still in positive territory, still in an incline, which is also a very good sign. So when we're looking at this data, this supports the idea that the economy is stronger than we were feeling a month ago. I know that may be hard, especially if you see a lot of bad news and you look at a lot of sites that share bad news. It may be hard to get your head around that, but I will tell you that when we look at the fundamentals, these technicals do line up with it. And again, another 30 days will tell more. But for now, that's not terrible. That's not terrible at all. Let's now take a look at the Dow. So with the Dow, looking at the last 6 months again, we can see something similar, although it's interesting. You'll note that on today, it really had a big jump up. You'll see that the bottoms are going higher. The tops are still getting lower, which means we're having a consolidation where as the tops get lower and the bottoms get higher, it makes it so that at some point we have convergence, divergence, and the moving averages break above. The 200-day moving average is kind of flattened out right here. The 50-day moving average is kind of negative, but I think you'll find over the next couple of days, if it holds in this position, that it's going to go higher. Again, this supports the data that we were looking at before as far as the fundamentals of the US economy. Let's take a look now at the NASDAQ. Okay, the NASDAQ, because it's much more tech heavy and it has been problematic, what we see though is we see that it is still below both the 200-day moving average and the 50-day moving average. It did make a pretty decent move here recently. It tried to pull up, and that's a good thing. But because it's so tech heavy and because tech has had such an incredible run up over the last number of years, it's kind of tinkering around with that whole thing for a while. So while this doesn't necessarily support the data, I don't know if because the tech has had such a great run up, if we're not seeing some consolidation there, some return and some pullback that's designed to sort of recapture some of the opportunity out there that exists. Again, I would probably defer another month on this before we get too excited one way or the other about it, because I think tech is not going away anytime soon. And if you look at where it was from its highs, quite honestly, we're down about 20% on this, but I don't know if this is a permanent issue. I think this is more of a temporary issue. Again, depending upon how recession, depending upon volatility, which may or may not be connected to recession goes, we could be looking at something here where maybe in another month or two, we might see some better numbers. Again, as always, we're watching this carefully and being proactive wherever possible and reactive whenever necessary. And then finally, probably the one that gives me the most concern is the VIX. because the VIX is always looking out 90 days into the future. Those are options contracts, and those options contracts are all about trying to figure out where everything's going. And if you'll notice here, you can see that from back even in November of last year, the bottoms are getting higher each time, and so are the tops getting higher each time. The particular activities above the 200-day moving average, the 50-day is moving down, which is a good sign that the market is slowing, that the VIX, the negative, is slowing down, but it's still a little bit concerning. So I think this is a communication by those who trade in options over the next 90 days that they're still concerned about where things are going to be, say, 90 days into the future, which isn't unreasonable. I think that as I was preparing for today's update, I would say I was kind of surprised by some of the good numbers that I saw. I did not expect to see information quite as strong as it was. Do I think that means we're out of the woods yet? I don't, but I do think that it means that we have some opportunities, and that if we're diligent and we're wise about what we're looking at, we could make some good decisions along the way. And from my viewpoint, what this says to me is I don't want to be out of the market yet. And when I say yet, I don't mean this week or this month. I'm saying I feel like there's a lot of indication that says we could probably stay invested longer. But at the same time, I would also say that every day presents new information, and that new information causes me to re-examine what we're doing. Again, 2 weeks ago, 3 weeks ago, I wouldn't have thought that Elon Musk was going to try for a hostile takeover of Twitter. I wouldn't have thought that Twitter was going to take a poison pill. I wouldn't have thought that BlackRock and Vanguard would have jumped in and tried to take over more of that. These are all things that you don't always know what's happening, but I would say that with all this new information, it is definitely something that bears review, bears diligence, and we're staying on top of it for you. And just as you're staying on top of it to give us information, help us kind of rethink how to manage your money, because I've had a number of conversations in the last couple of months about risk scoring, the Riskalyze test that you all have taken, the assessment to identify what risk you're at, where you want to stay at the portfolio, and sharing information, and trying to figure out how all of the fundamental and technical analytics we're talking about are tying back into that. So let me go back here now on where we were before. There we go. So as I said before, we can take a look at the analytics, and they are in most cases better than what we had before. I wish the NASDAQ were a little more up than it is right now, and I wish the VIX were a little less up than it is right now. But again, we're watching carefully as we go into the summertime. The summertime tends to be a slower time as well. So here we are, it's April, May's coming, June's not far behind. There's a number of pieces. Even the idea of what another issue with Omicron, for instance, could do if we had some more with COVID that came up, various pieces that could change that. Same time, on the plus side, we've got an election coming up. There's a lot of both hopefulness and concern about what that election could hold. And I think all of that would have some impact on the markets and the economy as well. So we'll be watching that carefully, just as you are as well. So with your portfolio management, what are the options that we can do right now? Well, first, as I said, I think in the last month's meeting, we can utilize assets or securities that are negative correlators to overall equities market, meaning we can choose things that are going up when the market's going down. And in some cases, we are doing that to a small degree with some particular accounts just to protect us on the downside, but not aggressively yet. But if you were really concerned about inflation and what it's going to do, or a slowdown because of rising interest rates from the Fed and how that would impact inflation, then we can certainly get more heavy into that. If you want to give a call or an email and we'll talk about it, be happy to go over that with you. Not to talk you out of it, but to understand what you're thinking, and then to offer some counsel so then we can make decisions together on what makes sense for you. Number two, we can adjust the portfolios to more conservative positions immediately, currently, to protect against further portfolio erosion. I've talked with a number of clients on some of the positions where I said, maybe it's time to go ahead and get out of those now and lock in either gains or minimize potential losses. Certainly those are options as well. That's the second choice. And again, we can talk about that if you'd like to. And then finally, number 3, continue reviewing fundamental and technical analytics and then adjust the portfolio to more conservative positions if and when the fundamental and technical data supports that adjustment, which that goes back to my sentence that we are proactive wherever possible, reactive whenever necessary. And by setting up that model, it gives us the best opportunity. Will we catch it at the top every time? Nope. Will we catch it at the bottom every time? Nope, because we're not day trading. We're trend management. We're looking at that early upswing or that early downturn and recognizing when it looks like it's the wisest move to make that adjustment to either protect capital or to take advantage of opportunities. So using either 1, 2, or 3 as options, there are certainly ways to take this portfolio, take your portfolio and manage it more appropriately for where you are if you have a lot of concerns. There's no sense losing sleep at night about this. We need to make the best decisions possible. On a side note, I tell you, from all of you that I've spoken with, I'm really proud of you. You seem very committed to what you're doing. You seem very strong in your beliefs. And when you have questions, you ask intelligent questions. It makes perfect sense. And so if you feel like it's time to make adjustments here, items 1, 2, or 3, let me know. And let's talk it through to make the best decision for you, because you're the boss, I'm the employee, and we're trying to make this in the best model to suit your needs for your short-term, mid-term, and long-term goals. So with that in mind, portfolio diversification is like this. We look at cash reserve. How much do you need in cash? Either for liquidity needs, cash reserve needs, future, meaning over the next 6 to 12 months, liquidity needs, etc. Bonds as a way to create some stability in the portfolio, although with rising interest rates, not my favorite choice, but certainly at other times has been a great choice. Equities, owning companies that you have ownership assets in the economy, and as those companies grow, back to corporate profitability on that airplane a minute ago, as they grow, so do you. When they're volatile and they go down, we can look for opportunities to buy them. If we go into recession, we should adjust the portfolio and change the weighting to things that are more conservative in nature. Real estate, how much either money or percent should your portfolio be invested in real estate? Because it's a great asset. You get no pushback from me for those of you who like real estate, whether it's residential or it's commercial, single family, multifamily, certain types of commercial properties I'm not a big fan of, like hotels, for instance, which have been pushed against by Airbnbs, or if we have retail spaces, sometimes those have been concerns. Certainly some of our liaisons with some of the real estate programs we work with, they are very clear to point out that not all commercial is bad, but you got to look for special opportunities, which is one of the things that we do with those types of programs. But real estate has been a great asset. Matter of fact, it's rivaled equities as far as performance opportunities. Tangibles, I mentioned what we did with oil or energy, not too long ago. Certainly metals have been doing well. Commodities with inflation have been doing better. So there's other opportunities there to diversify a portfolio. Currency, the rising dollar or a strengthening dollar or a weakening dollar against the world's economies certainly is an opportunity. And while we can't do any crypto here, I know that many of you are, and we've had great conversations about it. Business interests, which represent private companies that we can't invest in the stock market. There's only 6,500 of those, but there's 2 million companies, and we put together a number of resources where we can invest in roughly over 100 companies now that are not publicly traded, and all we have to do is really look at their business risk to make sure that makes sense. And then finally, insurance and annuities, which I know for some of you are bad words, but the fact is those programs give us stabilizers, protections, in some cases guarantees against loss of principal or income to pay out, plus providing liquidity and flexibility and giving us the ability to make those portfolios look like these other 7 in some form or fashion, and giving those stabilizers or protections at the same time. So what percentage should your portfolio be broken out into? When we take a look at your tactical consensus, which is how we're helping you divide the money up, those assets under management with us, and then those AHA or assets held away outside of us, helping you to take a look at your portfolio and make good decisions along the way. As we take a look at a portfolio and manage it, we're trying, just like you are, to make the best decisions. Because don't forget, when you, as a fee-based client, meaning that we don't charge any commissions or we have fees, if your portfolio goes down, I get a pay cut, and I'm not happy about that any more than you are. I mean, you don't care if I get a pay cut, but you don't want the portfolio to go down, and I don't either, because when your value goes down, you're not happy, our income goes down. On the other hand, if we can create growth in various environments, your portfolio goes up, you're happy, and I'm happy because we get a pay raise in the process, which I'd like to think we deserve that because we're working hard to manage wealth wisely. So as we look at those 8 circles, as well as the 10 concepts, that's how we try to make good decisions to manage wealth wisely, to create, grow, protect, and preserve wealth for you and your family. I see a couple of you have questions, but I'm going to save it just a little bit longer on that. So if you can make notes there, I'll be happy to get back to that. Now, in this process, we provide you 4 complementary wealth management apps to help you manage wealth wisely for your family. And those are your wealth management dashboard, which shows all of the assets you have. And then also we have the financial life planning app, which helps you identify life transitions you want to look at over the next 12 to 24 months, life goals, things that you want to accomplish during your lifetime. Down here we have the risk reward analyzer called Riskalyze, which is an assessment to help us understand how you feel about risk and how that compares with your portfolio. So for instance, in this little example here, if a person scores 73 out of 99 and your portfolio is 95, we probably should talk about that. On the other hand, if you show 73 and your portfolio is 41, we probably should talk about that too, to make sure that we're managing your portfolio, both assets under management as well as assets held away, in a way that makes the most sense for your risk needs and your growth and reward needs as well. And then finally, for your portfolio management dashboard, this is assets you have with us directly. This gives you performance information and shares with you what's going on and gives you all kinds of detail as to what we're doing with your portfolio management. And again, these are all provided available for you. It's just part of our service. And if you're not utilizing them all, please check with me, because I'd love to make sure you get benefit out of all of these. So now we're going to take time for some questions. Looks like there's a few there, so let's see what we got here. All right, John asked a question. Let's see what his is. Well, come on, open up here. There we go. Nope, that's not it. No. All right, oh, here we are, down here. Okay, the last time we spoke, you said you weren't sure of the future. Do you see any new trends yet? Okay, I'd first off say, John, I'm still not sure of the future. If I was sure of the future, that should be scary. I am not sure of the future. But what I would say is the new trends I've been talking about, or maybe it's a confirmation or an affirmation of some of the trends we're seeing right now, leads me to believe that I might have been a little more concerned about potential recession than I should have been. But I'd be the first one to say that I still think there's a lot of moving parts out there, a lot of things that could change everything. And so this today, what I'm sharing with you is not a statement of faith, if you will, that, oh, it's all over, we're all good. I don't know that we are. I don't know that's the case. I do expect recession, and I do expect, like you saw in those other charts, that when we have those recessions, it will likely drive the market down. And I want to be on top of that and minimize that as much as possible. What I would say the trends are saying to me at this point is, I'm just not sure that it's going to be in the next 6 months. I might not even be in 22. I don't know yet. But as we go through each month, I promise you that I will be watching for it, sharing information. And as I've told you before, if things get really crazy quickly, I will be the first one to say, let's get together and talk about that. Where did there we go, got it, okay, cool. Let's see here, is there anything else, any other raised hands or anything? Okay, nope, looks like not right now. All right, well, I'm still on here, so between now and the next few minutes, if you have a question, feel free to chat or to raise your hand, and I'll be happy to go through that with you. And also, if after the webinar is over, you think of another couple of questions or something you want, feel free to email me. This says to info at Frank's office. You can do that, that'll get to me. But as you all know, you can email me at fr@Frank's office, and we'll take time to get back to you, whether that's to answer the question by email or schedule a phone call to talk about it, or schedule a meeting to drill down in more depth on it. So that's also available to you. I always don't like that sound. It means I didn't do something right. Okay, so the next update, May 17th, we're going to have another update where we're going to continue our conversation about how to create, grow, protect, and preserve wealth. We'll probably take a look more at market fundamentals and technical analysis, as well as economic analysis and expectations. And if things continue to improve, I'll probably want to start back into our discussions. We were just starting to get to this place where we were talking about some of the planning, investment, and insurance solutions for you and your family, and for those of you who own businesses, your business as well. And then, as always, we'll take time for questions, which, let me say something else here too. I've said it before, but I don't think I've said it recently. Prior to these updates, so prior to May 17th, if there's some questions that you would like for me to discuss, feel free to email me and say, hey, on the next financial update, would you please talk more about this item? I'd be more than happy to review items. Now, do me a favor, don't mail it to me on the day of. I may still be able to talk, but it would be very helpful if you would email it to me a couple of days in advance so I could do some research and drill down and say, okay, here's some more information that might be important. But feel free to utilize that so we can have that conversation and make sure we answer your questions. So here's what we've done. We have reviewed reminded you, hopefully, of the fundamental and technical analytics that we've been discussing the last couple of months, and talked about the four primary engines to economic growth. Recession potentiality, which I would say is probably down a little bit now. Not that it's not going to happen, it is going to happen, but whether or not it's this year or not is still up to question. Potential entry and exit strategies, it's always, we're looking for those. And when I show you the technicals on the Dow or the S&P or NASDAQ, those are giving me entry and exit points that we're looking for here. And that's why I show you those lines running across. So at this point, I'm like, well, not bad. And I'd also be quick to point out that, say, the S&P 500, that's a very broad index, but there's various industries inside of there: real estate, financials, energy, materials. There's various industries that are doing better than other industries, and so they also represent more drill down as we sort of do a top-down look at that. And then inside those industries, there's various sectors for those industries, and then various securities inside those sectors. So when we're talking about entry and exit strategies, we're talking about on several different levels, not just the S&P 500, but a lot of comparative data that I don't bore you with, but when we have a conversation in the office here or on a webinar, I'm more than happy to share more details about that as well. Taking a look at portfolio management options. Again, if you have any concerns, this is a great time to talk about it before things get wonky. Not that I'm saying they're going to anytime soon, but again, don't wait. Let's talk about it sooner. If you're not utilizing our apps, please do. I pay good money for those so that you can have great information. It makes me happy when I hear you're using them. So please use them. And if you're not quite sure how to use them, let us know so we can help you with that. We took time for some questions. I don't see any more questions yet. Where are you at here? Oh, that's that. There we go. Sometimes it just doesn't like to play nice. All right. And I don't see any more questions right now. Very good. So as always, this particular update, we do this on the third Tuesday of every month. This is available to your friends. It's available to anybody, your family, anybody you care about who you think might like to hear some of this information and maybe use it to help them with their portfolio. If you would like for them to attend, just let us know so we can send them an invite. And as always, you have my word, we're not gonna like inundate them with calls and say, hey, now you attended a webinar, talk to me. You know we don't do that. But if you let us know and they'd like to attend, we're certainly happy to do that and answer any questions for them as well. I had a referral just the other day come from another friend, and so we're in the process of helping. And it's just a conversation just to help them make good decisions. So again, this is always available to you. Email Sherilyn, we call her Sherilyn at franksoffice.com, and she'll make sure that they include it on the next webinar. So there we go. That's what I thought. Okay, so there we go. I think that's all for tonight. Hopefully you're walking away with a little better feeling than before. And if you're not, then email me or let's schedule time to talk and see what we can do to help make sure that you're feeling as confident as possible when it comes to making good decisions on how you're managing your family's wealth. because it's critical. You know, you want to make sure your money lasts as long as you do. We want to make sure it does. We want to make sure that it's as enjoyable a process as possible for you. So with that being said, I'm going to head out. I didn't say at the beginning, but I hope you all had a fantastic Easter. And I'm going to go get some dinner now and enjoy myself this evening. And as always, I am honored, and I mean that, by your trust and your confidence. And if you need anything from me, please let me know. Whatever I can do to help, we are here. My whole team is here, whether it's just me or it's Brent or Stephanie or Paul or Kelsey or Alex or Stephanie. I think I might have said Stephanie, Cher. We're all here to help you. And so please use us. That's what we're here for. And again, if we can do anything to make things work better for you, I'll do that. So having said that, I'm out of here. I'm gonna get some dinner, thinking about having sushi tonight. So hopefully you're gonna have a great dinner as well, and I will talk to you all soon. So have a fantastic week. And again, if you need anything, email us, call us, we're here for you. Have a great night, and I will talk to you soon. Bye-bye.